Picture this. You need $20,000. Maybe it's a new roof, because the last big storm finally found the weak spot you'd been ignoring. Maybe it's the trip with the grandkids you've been putting off for years, the one you keep telling yourself you'll book next summer. You log into your retirement account, you pull the money out, and the job feels done. Then tax season comes, and the number on your return doesn't say $20,000. For some retirees, that one $20,000 IRA withdrawal can cause more than $31,000 of income to become subject to federal tax. Not because of a mistake, not because of a hidden fee, it's because of how withdrawals interact with Social Security taxation, and most people find out after it already happened. Here's what's coming in the next few minutes. You'll see the 3 places your retirement money actually lives, and why the IRS treats each one completely differently. You'll see the 3 specific triggers: Social Security taxation, Medicare surcharges, and required withdrawals later in life, and how pulling from the wrong account at the wrong time can set off all 3 at once. You'll see why the common advice, spend one account completely before touching the next, is usually the wrong move. And near the end, you'll see 2 real strategies run through the same spending goal, with the actual dollar difference between them. Stay through to the checklist at the end. It's something you can use every single year, not just this one. Let's start with the part almost nobody explains clearly. Once you retire, your paycheck stops. But your need for a paycheck doesn't. Social Security and any pension you have will cover part of it. Everything past that you have to create yourself by choosing which account to pull from and how much. Most people default to one simple question: which account has the most money in it? And they pull from that one. That single habit is where most of the tax damage begins, because it ignores something important. Not all retirement dollars are treated the same by the government. You generally have 3 types of accounts. A taxable brokerage account, where you've already paid tax on the money you put in, and you only owe tax on the growth when you sell, usually at capital gains rates. A tax-deferred account, your traditional IRA or 401k, where nothing has been taxed yet, so every dollar that comes out is treated as ordinary income, the same as a paycheck. And a tax-free account, your Roth IRA, where qualified withdrawals are completely tax-free and don't even count toward the income totals that other rules are watching. Think about it this way. If you sell some shares from a regular brokerage account to cover a car repair, the tax bill on that sale depends largely on how much gain is built into what you sold, how long you held it, and where your total income falls that year. Pull the same dollar amount from a traditional IRA instead, and the entire amount gets stacked on top of your other income, taxed exactly like a paycheck would be. Pull it from a Roth, and in most cases, nothing gets added to your taxable income at all. Same car, same repair bill, 3 completely different tax outcomes depending on which account you chose. That last part matters more than people realize, because 2 other systems are quietly watching your income every year, whether you notice them or not. The first is Social Security taxation. For 2026, if you're married filing jointly, the IRS looks at something called your combined income. That's your other income, plus any tax-exempt interest, plus half of your Social Security benefit. If that combined number stays under $32,000, none of your Social Security is taxed. Between $32,000 and $44,000, up to half of your Social Security benefits can become taxable. Above $44,000, up to 85% of your Social Security benefits can become taxable. And here's the detail that catches people off guard. Those thresholds were set decades ago, and they've never been adjusted for inflation, which means every year, more retirees cross into taxable territory without their income actually going up in any meaningful way. A single extra IRA withdrawal can be the exact thing that pushes you over the line and pulls a chunk of your Social Security into the taxable column along with it. Picture it this way. You pull a little extra from your IRA for a summer trip. You never touched your Social Security check. But at tax time, part of that Social Security is suddenly taxable too, just because of the withdrawal you made for the trip. Here's how the number from the beginning can happen. Say a married couple receives $40,000 a year from Social Security, plus $10,000 from other sources. Before the withdrawal, Their combined income is $30,000, so none of their Social Security is taxable. Add a $20,000 IRA withdrawal, and $11,100 of their Social Security becomes taxable too. The withdrawal was $20,000, but it caused $31,100 to be included in income for federal tax purposes, before deductions. The second is Medicare's income surcharge, officially called IRMAA. For 2026, if your income 2 years earlier was over $109,000 as a single filer, or $218,000 as a married couple, your Medicare Part B and Part D premiums start increasing in tiers. And this one has a strange timing quirk. It looks back 2 full years. So a large withdrawal or a big Roth conversion you make this year might not show up as a higher Medicare bill until 2 years from now, long after you've forgotten what caused it. Imagine selling some investments 1 year to help with a big family expense. 2 years later, a letter shows up saying your Medicare premium is going up, and nothing in your life that year explains why. That's this rule at work. The third is required minimum distributions. If you were born between 1951 and 1958, RMDs generally begin at age 73. If you were born in 1959, check the latest IRS guidance before making a decision. If you were born in 1960 or later, RMDs generally begin at age 75. At that point, the IRS stops letting you choose. It forces you to withdraw a set amount from your traditional accounts every year, whether you need the money or not, and that forced withdrawal is taxed as ordinary income. Even in a year you stayed home, spent almost nothing, and didn't need the money at all, the IRS still makes you pull it out and still taxes it. The more you've built up in tax-deferred accounts by the time this starts, the bigger those forced withdrawals get. That can make more of your Social Security taxable in the same year and raise your Medicare premiums 2 years later. None of these three work in isolation. That's the part that matters most. One withdrawal from the wrong account in the wrong year can nudge your Social Security taxation up, move you closer to a future Medicare tier, or leave more money in tax-deferred accounts that may force larger RMDs later. It's not three separate problems. It's one chain reaction. So, here's a common belief worth breaking. Many people assume the smartest approach is to spend down one account completely, then move to the next, then the next. Taxable first, then the IRA, then the Roth, in strict order, like paying off one credit card before starting the next. That's rarely the best approach, because it ignores your tax bracket entirely. The real question isn't which account should I empty first, it's which dollar this year does the least damage when I pull it out. That means using a mix. In most years, a mix of taxable withdrawals and a carefully sized IRA withdrawal, kept inside a target tax bracket, works better than draining one bucket at a time. And your Roth generally works best left alone as long as possible, growing tax-free, so it's available later for the years your other income is higher, or for a large one-time expense, without pushing you into a higher bracket or tripping a Medicare threshold. Now let's make this concrete. A retired couple, both age 62, has not started Social Security yet. They need $70,000 from their savings this year to cover their spending, and for this example, assume they have no other taxable income. Everything else is identical between them. Same accounts, same balances, same year, same tax rules. In the first approach, they simply pull the entire $70,000 from their traditional IRA, the way most people default to doing. Using 2026 tax brackets, that produces a federal tax bill of just over $4,000. In the second approach, they split the withdrawal. $40,000 comes from their taxable brokerage account, mostly long-term gains, which fall inside the 0% capital gains bracket because their other taxable income is low that year. The remaining $30,000 comes from the IRA. Same $70,000 spent. Same lifestyle, same year. The federal tax bill on that second approach comes out to zero. Same spending goal, same amount of money in their pocket. A difference of just over $4,000 in a single year created entirely by which accounts the money came from. And that $4,000 difference is only the first year result. Over time, the best mix can change as Social Security, Medicare, and future RMDs enter the picture. Here's the twist that changes everything, though. The strategy that works well at 62 is not automatically the right strategy at 73. In your 60s, before Social Security has started and before required withdrawals begin, your taxable income is often at its lowest point of your entire retirement. That's the window to lean on your taxable brokerage account, take some IRA withdrawals or Roth conversions up to a bracket you're comfortable with, and let your Roth sit untouched and keep growing. Once Social Security turns on, and once required withdrawals begin in your 70s, the picture flips. Now you have a strong fixed income floor every month. Nearly every additional IRA dollar you pull is more likely to make part of your Social Security taxable, because you're already closer to those combined income thresholds. In this phase, the order usually shifts. Required withdrawals come first, because they're not optional. Then your taxable account fills the rest of the gap, and your Roth becomes something closer to a reserve, saved for the years you need extra money without wanting to cross a bracket or a Medicare threshold. A new roof, a car, helping a grandchild with tuition. Money that comes out without dragging your other numbers up with it. Same 3 accounts, 2 completely different seasons of retirement, 2 different orders. And this is exactly where the Medicare Lookback rule from earlier becomes real. A big Roth conversion or a large IRA withdrawal you make at 68 while you're still filling up a low bracket might feel harmless in the moment. But because Medicare looks at your income from 2 years earlier, that same decision can show up as a higher Part B and Part D bill at 70, not as a warning, just as a bigger number on a bill you weren't expecting. The years when your income is naturally low are exactly when it's worth being most deliberate, because the consequences of getting it wrong don't always show up right away. Here's something worth remembering longer than any of the numbers in this video. The order you pull money from matters more than most of the choices you make inside those accounts. Before you decide, run through this once a year, ideally before you touch anything. First, add up your fixed income for the year. Social Security, any pension, anything guaranteed. Second, estimate what you expect to spend. Include the real things, the travel, the repairs, the help for family, not just the minimum. Third, subtract the first number from the second. That gap is what you need to pull from savings. Fourth, check where you currently sit relative to the Social Security thresholds and the Medicare surcharge threshold for the year. Fifth, decide how much of that gap comes from your taxable account, how much from your IRA up to a bracket you're comfortable with, and whether your Roth stays untouched or gets used this year. Sixth, if anything big happens mid-year, revisit the plan. A property sale, an inheritance, a large medical bill, it's allowed to change. The account you pull from isn't just where the money sits. It's a decision that touches your tax bill, your Medicare premium, and the size of the bill still waiting for you later. Most people never look at it that closely. Now you know what to look for. There are more retirement decisions like this, simple on the surface, but expensive when the rules collide. Subscribe, and we'll work through the next one together.